Hey guys, Florida Stacker here with you, answering some of the popular questions I'm seeing floating around about this banking crisis going on right now. So let's go ahead and get to them. As you know, yesterday, regulators, including the Federal Reserve, FDIC, and Treasury Department, did say that the depositors of Silicon Valley Bank, which failed late last week, as well as depositors from New York City-based Signature Bank, would have their total deposits protected. Question 1. What about Federal Deposit Insurance, or FDIC insurance? Well, the standard insurance amount is $250,000 per depositor per insured bank for each account ownership category. In most cases, depositors at these banks were not fully covered by FDIC insurance, as more than 90% of Signature Bank's $88.6 billion in deposits did exceed that $250,000 insurance limit per account, leaving billions of dollars in deposits uninsured. Question 2. What was this bank's business model? Many of the bank's clients were venture-funded tech companies. Signature focused on private companies and more recently on cryptocurrency firms. Having grown tremendously in size over a very short period, both of these banks were pursuing riskier investments in order to provide gains to its depositors during a period of time where interest rates were low, meaning bond yields were low. Question 3. Are uninsured deposits now covered by government guarantees? In this instance, yes, that's the case. The regulators yesterday stated they were making an exception for Silicon Valley Bank and Signature Bank. The action was taken in consultation between these agencies as well as President Biden. Both bank depositors are protected under a systemic risk exception to backstop their deposits. Question 4. So this is a bailout of two banks then, right? Well, yes and no. The bank itself as an entity is not being bailed out, as we witnessed during 2008 with the financial crisis. This time it is the depositors that are receiving special government assurances, meaning if you were a client of this bank and invested, $1 million with the bank in any of their funds, you, my friend, are protected. However, if you are a retail investor, and let's say that you bought 100 shares of Silicon Valley Bank in your Robinhood account, or you hold any of their corporate bonds, well, you're not protected. Question 5. So that means taxpayers are paying for these wealthy clients to become whole once again, right? Well, no, that's not the case per Janet Yellen. She states that no taxpayers are footing this bill and that the depositors will see their accounts recovered by a special assessment charged directly to the banks. I believe that means the banking industry and not obviously these banks that are in default. So per the government, the banking industry or perhaps their insurance will be footing the total bill for this. Of course, we'll see if that is actually true. Question 6, what about the other banks? Are they protected? That's a great question. So the Federal Reserve took another action on Sunday establishing what they are calling the Bank Team Funding Program, where banks holding safe assets such as government treasuries or mortgage-backed bonds can swap those assets directly with the Federal Reserve for cash in order to meet any demand for customer withdrawals. So it's easier for them to turn paper into paper, basically. Question 7. Weren't safe assets what got Silicon Valley Bank into trouble in the first place? That is true, but let me add some context, okay? Silicon Valley Bank held a tremendous amount of long-term government bonds that were purchased when interest rates were pretty low not that long ago, back when they were hovering near zero. These bonds do not mature for quite a long time, so the bank's bonds are now worth less than what they paid for them due to rising interest rates. For those of you that know about bonds, as interest rates rise and new bonds come to the market, they are more attractive as they pay a higher yield. So those bonds that were held by Silicon Valley Bank, they pay very little yield and are worth quite a bit less than they were purchased for on the secondary market. So the problem is potentially systemic, as any bank that does hold a large sum of long-term government bonds bought when interest rates were pretty low, could be faced with the same dilemma as interest rates rose rather fast over the last couple of years due to this reckless governmental spending. So once more, the Fed says they took actions on Sunday to establish the Bank Team Funding Program, so that potentially addresses the issue of other banks running into the same situation. Question 8. What about the regulators? Shouldn't they have seen this coming? All right, so most would assume yes. I myself will not be so quick to call this incompetence, however, as is being floated. However, it is also being reported now that Elon Musk was interested in purchasing Silicon Valley Bank, and that news of this potential purchase reached many of the wealthy depositors of Silicon Valley Bank last week. Let's take a second to remember that this is Silicon Valley in San Francisco. This is the heart of liberalism in America, and the vast majority of depositors with this bank, let's just say they don't see eye to eye with Elon Musk politically, which is considered a motive for the run that we saw in this bank last week. All right, Florida Stacker, what's your take? Okay, so here is my take now completely. At first glance, this appeared to be what I considered the right thing to do, which was to protect the depositor with FDIC insurance up to the federal limit of $250,000, just as would be the case with me, a middle-class guy, right? But this is San Francisco and New York City, and these are not your typical checking and savings institutions in a brick-and-mortar location right next to your local neighborhood grocery in all instances. These are mostly investment banks. These were premier lenders to numerous high-risk technology companies, including hundreds of high-risk tech-focused IPOs, initial public offerings. These banks lended to cryptocurrency firms, and they had funds that were very closely tied with ESG initiatives or green energy-focused projects like solar power, things that have not really done that well. And this is classic moral hazard here, in my opinion, and here's why. Over 90% of customer funds that were held and erroneously invested by this $200 billion bank exceeded that $250,000 threshold, and therefore, by normal standards, right, should be lost. This is an investment bank. They were investing client funds. Those investments failed or did not perform well enough, and now they're being bailed out. As Joe Biden said during his address, investments have risk, and with that risk can come the loss of money. And I thought that's where he was going to stick with this, but that's not the case, because in this case, the retail investor, the small guy like you and I assume, most of the viewers of my channel, I don't assume are $1 million investors. The small investor who may have, bought this bank or the other bank in its Robinhood account, or perhaps you own a banking sector mutual fund or ETF, well, you don't have any protection here. That's what Joe Biden was talking about when he said investments have risk, and with that risk, you can lose some money. Okay, so if you own this stock or a mutual fund or ETF, then you are not covered here. Now, there's another obvious reason that he may have decided to cover all of the deposits by the clients of these two banks. I'm going to give you the other side of the argument. And that reason is that Joe didn't want Florida Stacker running out to my local bank today and pulling out all of my cash. So instead, he woke up early at 9 a.m. and addressed the nation, although he took no questions. But he did state that depositors are protected, the investors are not, that this is all of Trump's fault for rolling back regulation with Dodd-Frank, and that no one needs to worry about their cash in any of their banks. And if you don't believe me, go watch it. That's more or less what he said. Now, I have to ask myself, why was this special exception made for these two banks and their depositors? And the easy explanation is politics, okay? Silicon Valley and New York City, wealthy people that place deposits with these banks. We're talking something in the area of between 90% and 97% of the clients held accounts with more than $250,000 in value. Investment banks, okay? These are the same people that just so happen to be the largest donors to Joe Biden's 2020 election campaign. All right, now listen, hear me out. Joe received about $1.3 billion in campaign donations during his last run for president, and the second largest group to donate to Joe Biden was the Future Forward USA, which is a PAC or a left-of-center liberal political action committee that was created in 2018 to support Joe Biden's election. Now, in 2020, Future Forward USA provided $61 million in donations to Joe Biden's campaign from the parent company, which is a 501c4 nonprofit, so donors' identities, when they make those donations, do not need to be revealed. That's $61 million. Now, this PAC is based in Palo Alto, California, in the heart of Silicon Valley. And the group received another $100 million in political donations during the last 5 weeks of the presidential campaign. Much of this group's individual contributions come from Silicon Valley mega donors, including Dustin Moskovitz, the co-founder of Facebook, who himself donated $46 million to Joe Biden's campaign. Now, this puts into question whether or not the Biden administration would have acted in the same manner had the banks in question today been that of Mar-a-Lago, Florida, or perhaps from Houston, Texas. I'll leave that to you to decide what you want to believe. Hopefully this video does, however, answer some questions for you. And at the end of the day, this is just another reason to not place your full trust in the fiat-backed banking system. And also to ensure that if you do have heavy deposits in these banks, that you are spread out across different banks in different regions of the country. I think that's probably something smart to do. Also, the market sees these events today as driving factors which may stop the Federal Reserve from raising interest rates again this month in March. There may not be that quarter to half a point basis point increase, even though we did see CPI at 6%, and it was just a little slightly higher than they were thinking. Obviously, when you look at non-core food and shelter, continue to rise month over month, another 0.5% up, right? So it's just getting much more expensive to eat and sleep in this country. All right, so these are just more reasons to stack gold and silver. And yeah, that's what I'm going to continue to do. We'll keep showing that here on the channel. And also, I just, I don't keep that much cash in my checking account. I keep enough to cover my expenses with a little surplus. I have a little bit in a savings account, which I can quickly access if I need to move cash to my checking account. But in general, I think there's some lessons that can be learned from everything that's going on today. And, this could just be the beginning. So we'll see what happens, right? All right, thanks all for watching. Have a great day, and I'll see you again soon on another video.
Thank you for watching our video. I hope you subscribe to our YouTube channel.